Hey everyone, welcome back to the trading floor. Today, let's talk about the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100 and is typically used to identify overbought or oversold conditions in a market. According to its creator, an RSI above 70 is generally considered overbought, while an RSI below 30 is considered oversold. Many traders have deemed these values to be too wide and have narrowed it down to 80 and 20, but do the testing for yourself and find out what works best for you. It's a versatile tool that can help traders gauge momentum, identify trend strength, and spot potential reversals. Here's the calculation for the RSI oscillator according to TradingView, but what's more important than understanding the calculation is understanding how to use it. There are several ways to use the RSI in day trading. The most common method is to look for overbought and oversold conditions. When the RSI crosses above 70, it might be time to consider selling, as the asset could be overbought. Conversely, if the RSI drops below 30, it might be a good time to buy, as the asset could be oversold. An important concept to understand is that when the RSI initially crosses into the overbought zone, it can actually be a signal of strength, indicating strong bullish momentum. Similarly, when it first drops into the oversold zone, it can indicate weakness or bearish momentum. However, if you're using overbought and oversold levels to anticipate reversals, it's crucial to use price action signals for confirmation. Look for candlestick patterns such as engulfing candles to validate the reversal. But an RSI is more than just an overbought and oversold indicator. You can also use it to identify trends, as the RSI tends to stay above 50 in uptrends and below 50 in downtrends. Now, let's use a simple beginner strategy using the RSI. This strategy involves combining the RSI with basic support and resistance levels and price action entry signals like engulfing candles. Here's how it works. First, you're going to want to identify the key support and resistance levels. Start by marking significant areas on your charts that have seen a lot of touches in the past. Next, look for the RSI conditions to be oversold or overbought. When the RSI gets above 70 and hits resistance, look for confluences to go short. When the RSI drops below 30 and hits support, look for confluences to go long. Lastly, you have to confirm the trade idea with an entry signal. Use a price action pattern to confirm your entry. For example, look for a reversal pattern such as a head and shoulders at resistance or a morning star at support to enter the trade. This strategy helps you to use the RSI to find reversals in the market's momentum while using price action to fine-tune your entry points. Remember to backtest before trading with real money, and always manage your risk with something like a stop loss. If you found this video helpful, like and subscribe, and if you're interested in joining the trading floor, click on the link down in the description.